Thanks for joining us on another edition of the Small Business Show with Jim Fitzpatrick, exclusively on ASBN.com.
Hey everyone, Jim Fitzpatrick. Thanks so much for joining me this morning for another episode of the Small Business Show, exclusively right here at ASBN.com. Raising venture capital is often seen as the holy grail for startups, but taking money from just any investor can be risky. Today we're going to break down how founders can approach VC funding strategically, not just as a one-way street where, they're being evaluated, but as a partnership where both sides need to, find that good fit. So to help us unpack all of this, we're joined by George Deeb. You've seen him here before on ASBN. He's an author, also a Forbes contributor and managing partner at Red Rocket Ventures. So thank you so much, George, for joining us once again to help unpack this area of VC. There's so many startups and successful companies out there that venture capitalists have helped in a very, very big way. But there are things to look out for, right? VC money is hard to come by. Shouldn't you take money from just about any investor if you can?
Most entrepreneurs think that, right? The reality is, you need to be screening the investors at the same time they're screening you.
Yeah.
Because the worst thing you can do is take money in from somebody that isn't really a good partner for you, that hasn't met the key criteria that are going to be successful for your business. And you really need to do your homework up front to make sure it's a true win-win both ways.
Yeah, for sure. As we've seen on Shark Tank, right, where the entrepreneur is sitting there saying, well, this person is going to be better for me on this. Maybe it's Daymond John because it's clothing, or maybe it's one of the others because it's something that could be sold on TV or what have you. So they're kind of trying to align themselves with the right investor as well, right?
Yeah, for sure. I mean, when I'm assessing an investor and deciding whether or not I want to take their capital, there's really three things that I'm looking at. I'm looking at the strength of the firm. I'm looking at the strength of the individual that I'm working with, and most likely the person will be sitting on your board. And I'm looking at the strength of their deal terms and the structure and the valuation and things like that. So, you really need to do your homework on all three things because they all play a role in figuring out the right partner for you.
Yeah, for sure. And so let's talk about each one of those. What are you what are you studying as it relates to the firm overall?
At the firm level, you got to make sure that they actually invest in your industry, right? Do they have a track record in investing in your types of businesses? Because if they don't, you're most likely pushing water uphill and you'll never get them to invest. So making sure there's a good industry fit is the first thing.
Yeah.
The second thing is, do they have a track record of success? Have they had many, portfolio companies achieve big exits, and they proves that they are good at picking the right deals, and they're good at helping those companies scale. So what is their track record of success? How reputable of a brand are they? Are they going to go look good on your cap table and make you look smart? As people say, oh, you're associated with Andreessen Horowitz, you must be the hot next thing kind of thing.
Sure. Yeah, very good point.
The third thing is, where are they in their fund cycle? Is it a first-time fund that's raised their very first fund, or is they've raised 10 funds and they've raised, in over a 20-year period of time, they've raised multiple series of funds that proves that their limited partners are happy with them, and that they've been able to continually attract new capital and keep their business thriving because their past successes have dictated to the investor group that, yep, I'm worth giving you more money because we're happy with your historical returns.
Yeah.
So that would be a third thing to focus on.
Sure.
More practically, where is that fund, their most recent fund, in terms of their investments? Is it fully invested? Are you the last round coming out? Are you the last company coming out of that fund, that there's not a whole lot of dry powder left, that they're going to have to go out and raise some more capital to get more dry powder to invest with? Or no, it's early in their fund. They can not only fund your current round, but they'll most likely have enough money to fund your second and third rounds at the same time. So, these are all very, very important points that you need to kind of assess.
Sure. What about at the team level? What are you looking for there?
Some of it's similar, right? Does that individual have experience in your industry? Do they have a track record of success? Are they a business person or are they a financial guy?
Yeah.
If they're a business person that's been in the trenches before, they can be consultative to you. They can be a mentor to you and kind of help you navigate whatever pitfalls you're kind of dealing with. So that goes a long way. Do they have references and solid, happy, other portfolio companies that can sing their praises and say, yep, we love this guy. He's going to be great for your business too, kind of thing. Where are they individually within their firm? Are they a senior managing partner that, is the decision maker? Or are they a junior, associate level that has, bosses on top of them that will actually be pulling the strings? So you got to make sure you know kind of where they are within their firm, and that, the most important thing is what's their personality fit? What's their management style?
I was going to say, yeah. Do you get along with them? Yeah.
Are you going to play nice with these guys? Right. You're signing up for a 5 to 10 year exercise. Make sure you get along with this person. That you speak the same language, that you share the same interests, the same vision.
Sure.
And they're not going to be, hanging that hammer over your head, and you're going to be unhappy about it.
Is it plausible for a founder to reach out to other companies that they have invested for that VC has invested in and speak to them prior to say, hey, give me 3 or 4 people that you've done this with already, and let me talk to those founders to see how the relationship has been and how it's gone?
Yeah, if a VC is not willing to give you references, it's probably not worth working with that VC. Of course, they should be asking that thing.
Right.
And if they're unwilling to do that, that should be a big red flag.
Yeah.
But nothing stops you from approaching those people directly. Reach out, let's say company XYZ, find them on their website, reach out to their CEO. I heard you took some investment capital from this investor. Have they been a good partner? What do you like? What don't you like? And then they'll give you honest feedback.
Right. So it's important on both sides. I mean, everybody's got a reputation. It's kind of like reviews with an Uber driver, right? Where they're looking for your reviews, you're looking for theirs, but it's alive and well in here. And I think that all too often, entrepreneurs and business owners, people that have got good ideas, they're looking for money. They have a tendency to put blinders on, right? And they only see one thing, and that is, oh, this person's going to fund my idea. And they don't do their due diligence in finding that right VC company, right?
Yeah, well, what they're doing is they're desperate for cash. They've been bootstrapped. They want to grow their businesses. All they really want is the capital. But what they really need is smart capital.
Yeah.
Right. Capital that comes with a brain with it is going to be a lot more effective than capital that doesn't.
That's right. What about the deal at the deal level? What are you looking for there?
All right, there's a few things here. I think the first thing is, obviously you're looking at the investment terms, right? And making sure you understand what the actual offer is and you're understanding all the specifics of the offer. The second thing is the valuation. And that's obviously a big thing that everybody's focusing about. What percentage of the company do I need to give up in relation to this transaction?
Sure.
And then the deal structure, what type of security are they investing in? Is it a debt instrument? Is it an equity instrument? Is it convertible? Knowing what you're actually going to have on your balance sheet and how risky that is for you going forward if things go wrong, because those documents are usually set up in a way that it's investor friendly, not entrepreneur friendly. And you want to make sure you're not teeing yourself up for a real mess if things turn south.
That's right.
Those are examples of things.
Because what you're saying is, conceivably, it could be they're coming in and giving that company a loan and also taking a piece of the company as well. But if it should fail and your name is you've tattooed that loan personally, then you could have lost your business, and those venture capitalists come after you for the $100,000, $200,000, $1 million that they've invested, right?
Yeah, for sure. I mean, anything that's structured as a debt is a liability that you need to pay back.
Right.
And when you're signing up that deal, you're optimistic. Things are going to go fine. I'm not worried about any problems. We're going to knock the cover off the ball, and we're going to have huge success.
Of course.
A year or two down the road, September 11th happens, or
COVID.
Or something happens that hurts the economy.
Yeah.
And now you're realizing you're staring down the end of a gun muzzle going, oh my God, I got this gun to my head and I didn't even realize it 2 years earlier when I signed up for this.
That's right. What's the most common structure? Is that the most common structure, that the investors are actually loaning money to that individual or to the company? Or how does that, what do you find out?
It's very rare that a pure debt instrument is the preferred structure, right?
Okay.
I mean, these investors are smart enough to know that this is a risky venture, and they don't want to cripple the company. So the most likely structured as a convertible preferred, or something that has some sort of equity tied to it, so that if the company hits certain benchmarks, it will convert into equity. And it's intended to be equity long term, but until the next round of investors comes in, they've structured it that they're sitting on top of the pile with this kind of preferred equity structure. But then when the next investor comes in, that next investor wants to be on top of the pile.
Right.
And all the previous investors are typically resetting their terms to be more traditional equity in nature. And then that process starts all over again with the new investor.
Wow. Wow. Sounds like, for an entrepreneur that's embarking on this, it sounds like a whole lot of information, or I should say, just that they're going into kind of the weeds here, because it's an area that most entrepreneurs don't know much about. Are there consultants out there, not on the investor side, or not going to the investor to say, hey, are you cutting me a good deal? But are there consultants out there that can help entrepreneurs through this VC process?
The best consultant on these type of things is a good startup attorney that structures these deals for a living.
Okay.
They live and breathe these investment documents. They know all the different type of structures.
Right.
They know what terms are investor friendly and what terms are entrepreneur friendly, and they can help you negotiate that deal. So it's very, very important anytime you're doing a transaction like this, that you surround yourself by a really capable attorney that does this for a living and can help you not make the mistake that hundreds of entrepreneurs before you had made.
That's right. And I think you said it best. It's got to be an entrepreneur an attorney that has got experience in this area doing these kinds of deals. It's not the attorney that you call that handled your divorce or handled your speeding ticket or your bankruptcy or whatever the case might be. This has got to be somebody that specializes and has done deals like this previously, right?
Yeah, for sure. Your advice is only as good as the person giving the advice, and you want advice from experts. You're not looking for a jack of all trades here.
No.
This is not your general corporate attorney that is helping you through all your normal business issues. This is somebody that's an expert in foundational capital structuring and making sure you don't make a mistake.
That's right. Now, I know this next question is a whole show onto itself, and we probably should schedule that. But when it comes time for valuation in a startup, in a company that is maybe pre-revenue or has very, very little revenue, maybe it's got a little bit of some money coming in on a monthly basis, but really nothing to speak of. But it could be a great idea. It could be a multi-billion-dollar technology one day or what have you. And these venture capitalists come in and they want to get as much of that as they can. How are you to put a value on that company when there's no revenue coming in, when there's no EBITDA to speak of, when there's no real top line revenue or any,
All right, so that's an excellent question, and yes, it's probably worthy of an entire show. The reality here is, in those situations, first of all, you've got to have something really unique, something really great, something really next generational.
Yeah.
For the investor to close their eyes to revenues and proof of concept and traction and all the stuff that they would normally expect. Okay, assuming that's you're ChatGPT. You're going to reinvent the world.
Right.
And you're going to take market share away from Google, and we got to put a value on this. So typically, what would happen is, there's a rational approach to it, that you're realizing, what size of a business could you really build here, and what kind of revenues can be built down the road, and where are we in our growth curve, and we're going to reasonably agree that this $10 million investment is going to get me 20 or 25% of the company.
Sure.
And there's no specific metric. It's not a multiple of revenues and not a multiple of profits.
No.
It's I'm willing to invest in this because I believe in you. I believe in the deal. I believe that at a $50 million valuation, that's peanuts compared to the $1 billion valuation that would happen down the road.
Right.
So that's one way to do it.
Maybe in that it has a lot to do with who that entrepreneur is, right, and who that founder is. If they have a track record of successful companies or what have you, then yeah, they're investing more in that individual than maybe they are the technology or the product or what have you. However, if it's somebody that goes, I left my corporate job to start this and I've run out of money, but it's a really big idea, then they're not investing as much in that founder as they are the idea itself, right?
Yeah, for sure. I mean, the quality of the founder is one of the most important things that the investors are looking at. If Elon Musk came out and said, "I've got the next $1 billion idea, and I need $1 billion to pull it off, and I'm only going to give you 10% of the company," a lot of his Silicon Valley friends would probably say, "Yeah, okay,
Yeah, of course.
You've done it multiple times
That's right.
over.
That's right.
You know, you've got a proven track record. We've seen it with Tesla. We've seen it with your space business. You know, we know what you're trying to do with X, or whatever it is."
Yeah.
That guy could do pretty much whatever he wants.
Sure.
But most of us are not that guy.
No,
right?
no.
We have to make sure we're selling a good enough story and we're not being too greedy with our ask.
That's right. That's right. I'm going to hold you to it that we do a show just on valuation, because I think there's so many pitfalls that you've got to stay away from, and then also things that you really need to focus on as you're looking for investors, whether it be a VC or even a friends and family raise, right? That somebody comes in and says, "Hey, I'm your best buddy, and I'll give you 50 grand to get this thing started, and now we're 50-50 partners. And in 2 years, the company's worth $100 million." It's like, really, So, but you hear about that all the time. So,
looking forward to that next show for sure.
Yes. Any closing thoughts on this topic?
Well, I mean, the guidance I'd give most entrepreneurs are, not all cash is the same shade of green. Okay, you might think it is, but it's not.
Right.
Please choose your investors wisely to really increase your odds of success and personal happiness through this process. Because if you choose wrong, everything can turn south, and you don't want to get yourself caught in that situation.
So true. No question about it. George Deeb, author, Forbes contributor, and managing partner at Red Rocket Ventures. This man knows exactly what it takes to be successful in business today, and he's going to steer you in the right direction. That's why we love having him on ASBN. So thanks so much. Really appreciate it, George.
My pleasure, Jim.
Thanks.
Thanks for watching another edition of the Small Business Show with Jim Fitzpatrick, exclusively on ASBN.com.